Good afternoon, everyone, and welcome to the ISA at Work panel. In this session, we're going to be talking about income share agreements, particularly in the context of adult and career education programs. Income share agreements, otherwise known as ISAs, offer a promising, if still somewhat novel option for funding post-secondary education programs, including adult career education and training programs. Late in 2019, the Department of Education announced that it was initiating an experiment with these programs. As ISAs migrate from the margins of financial aid to the mainstream, the debate around them is growing more vigorous. This afternoon, we have a distinguished panel of leaders involved in various facets of post-secondary education and career training, delivery, and funding. Joining us are Tess Michaels, CEO and founder of Stride Funding, an end-to-end provider of ISA solutions for institutions and funders. Chuck Trafton, president and co-founder of Edley, facilitator of an ISA marketplace which connects investors in ISA programs and products. Dan Friedman, president and co-founder of Thankful, a Chegg company, an online school for career changers with a focus on the historically disenfranchised, which offers ISAs as one funding option for students. And Austin Allred, CEO and co-founder of the Lambda School, an intensive IT career education program 100% funded by ISAs. I encourage you to read the presenters' detailed bios in the conference site. I also invite you to please upload your questions via the chat feature on Zoom, and we will go ahead and get started. I'm going to start with Tess and maybe Chuck as well. If you could share with us the current sort of state of play in the ISA marketplace generally, and more specifically in adult career education and training, particularly in terms of approximate total market size, number and type of providers, percentage of learners using ISA products versus other funding alternatives. Tess, do you want to take a shot at that?
That sounds great, Larry. Thank you. And thank you all for attending our panel. So the ISA space still is very nascent, but has been growing very rapidly. If you actually look at the market, when you go back to 2015, there were only a few ISAs that had started. And, if you look over the last few years, ISAs have grown to be about $250 million of allocated capital. Between Title IV universities and bootcamps like Thankful and Lambda, you see near 100 institutions utilizing ISAs to date. Which is pretty incredible to see the growth of the space. And awareness itself has also rapidly increased. When you look at Google Trends, it's up fourfold over the last few years. And when you look at, the press and news around ISAs, I think there's increasing mind share and market share, especially considering the flexibility and affordability compared to traditional loans. Chuck, would you want to add anything to the broader landscape and how it's evolved?
That's a good summary. I mean, it's a small market. It's a small asset class. About 250 million of ISAs were originated last year, but it's been doubling every year for 4 years. I think that in the context of COVID, it's taken on a new perspective. And that the first one of which is that this year, the private student loan market, which is really where ISAs compete. ISAs don't really compete with federal student loans, which is 85% of the student loan market. We compete with private student loans. And private student loans are discriminatory and regressive and punitive in that they are completely dominated by FICO scores and cosigners. And today, if you're not from a wealthy family, or you're not already wealthy yourself, which very few 20-year-olds are, it's very difficult not only to get approved for a private student loan, but to get one that's on reasonable terms. I talk to students every day, and we see even nursing students in their senior year of university with parent cosigners being quoted 17, 18% interest rates on private student loans. And that is a systemic problem in the higher ed ecosystem. is that for low and middle income families who don't come from a lot of wealth, it's very difficult to qualify for private loans. And so ISAs, most of the providers do not require FICO scores and do not require cosigners. It's not about how wealthy your parents are, it's about what is your potential. And so that's how we, and I know Tess also underwrite the students, is based on not where they come from, but where are they going. And you might be a 580 FICO score, but if you're going to Lambda School, you're probably going to turn out like X, and we underwrite to X. And so the ISA phenomenon has taken on this new context because financing and government and corporate interest rates are record lows. That is not true in the private loan market. And the second thing is that schools are now really under the gun to figure out how to convince students to come back. And given what I just described in the loan market, how are they going to pay for it? And being able to offer something innovative and forward-looking that is not debt, a lot of schools are finding this attractive. So in our case, I think COVID has accelerated our backlog and pipeline by probably 18 months. And this couldn't come at a better time when 30 million Americans have lost their jobs, and many of them parents of students.
Chuck, I heard recently, perhaps from you, that the private student loan market this academic year is $18 billion. Is it fair to project that represents an addressable market for ISAs? How much potential kind of overlap is there between the two asset classes?
Yeah, not all private student loans can be funded by ISAs because in some sense the lenders can make up for poor outcomes or attending a mediocre school or having a bad outcome with a high interest rate and high fee structure. With ISAs, we're underwriting the success of the student. And so, that entire market is not really the TAM for ISAs. It's probably a third of that market. There's 120 billion new student loans created every year. 110 billion of it is government loans. It's not really where we compete. We do compete in the private loan, and there's 7,000 schools in the US. We track them all very closely. We score them with something we call EdScore, which we think is going to replace FICO in funding higher education. FICO, as I mentioned, is punitive, discriminatory, regressive, and it's really irrelevant for most young people. Mm-hmm. And so it's incumbent on doing a FICO score on their parents. So instead of using FICO, we use an EdScore, which is an algorithm that combines the school's graduation rate, its job placement rate, the average salary, wage inflation, the default rate of students once they do graduate. And we just think this is a much better way to underwrite the millions of Americans who drop out of school every year because they can't afford to come back and they're just tired of the loans, and the millions that never even enter the workforce training or higher ed ecosystem because they can't afford it. And one area I would point out that is a passion project of ours at Edley is vocational schools. Most of the attendees of this conference and listeners are universities, and universities for the most part do a great job on outcomes. But we have a systemic and a social problem in this country of ignoring the industrial skilled labor market. For 40 years, we've said that everybody needs to go to college. That's just not true. And for most vocational schools, there are no federal student loans to get a welding job, HVAC, plumbing, diesel mechanics. These are plentiful jobs, but the classrooms are half empty because there's no federal student loan program. ISAs are helping change that game. So we think the TAM in the next 5 years is $4 or $5 billion annual issuance. We were founded 18 months ago, and we've funded 2,500 students so far for $22 million. And the demand both from the students and the investors has been very strong. Great. Look for it to continue to grow.
Thank you. So Dan and Austin, can you talk a little bit about sort of the implementation and development of ISAs in your programs, and maybe first talk a little bit about your programs and the kinds of students that are enrolled in them, and what their other funding options or availabilities might be. Dan, do you want to go first?
Sure. So a little bit of background on Thinkful. We offer pathways to careers such as software engineering, data science, data analytics, as many bootcamps do, and we also offer programs like digital marketing, sales, product management. So we've expanded beyond just the core of the traditional technical skills that a lot of the alternative education providers have started with. We first offered ISAs back in about 2016, when it was mostly a curiosity for the market. And what the potential that we saw was to drive much greater access to folks who have historically been shut out. So if you go back to that moment, the types of people attending boot camps tended to be folks who already had a college degree, who already worked in tech, who were making more of a small sideways change with an additional skill set, as opposed to folks who would otherwise be turning to traditional higher education, who may not have a complete college degree, who may have an associate's degree or some college credit, who may not have as strong professional experience, and as a result don't have the kind of savings that lets them pay $10,000 or $15,000. So through 2017 and 2018, we expanded. We first saw ISAs through the first couple cohorts of outcomes, and ensured that those outcomes were like the rest of our outcomes. Because at that point, we've been working in this area for 3 or 4 years. So we had a bit of a data set to draw from to understand, do students who choose these perform as well as our broader population? And we saw that they did. And then through 2019 and through 2020, we've continued to double down on ISAs by offering the option to take a living stipend, so that if you don't have enough savings to cover your personal expenses through the 3 to 6 months of full-time training, you would be able to defray at least some of those expenses, not cover everything, but at least cover some of it, so that you only need a little bit of help on the side. And fundamentally what we believe is people want more and more relevant skills for lower and lower prices. We are not necessarily all in on ISAs. It is a minority option for us. Most students choose to pay up front, pay month to month, use a traditional loan. We're happy to offer all of those options. For some people, the option of an ISA is the most attractive and the best one, where you pay nothing now, you pay a little bit extra later. And we're quite happy to serve folks in both. In the last 6 months in particular, I wouldn't say we've seen a spike specifically in ISAs. I would say we've seen a bit of a proportionate increase in interest across the board. And we've particularly worked to make all of our payment plans more affordable. So we actually in June did a large set of price cuts across the board, so that upfront our most affordable program is only $4,000. So obviously the number of folks who can't pay $15,000 upfront is really, really high. The number who can't pay $4,000 upfront is at least somewhat smaller. And so we want to make whatever option is the right fit for whoever's interested, affordable, and covering whatever the most relevant skills are.
Okay. Thank you. Austin, anything?
Yeah, so Lambda School is similar to Thinkful. We train people to be software engineers, data scientists. Slightly differently is we are almost entirely driven by ISAs. So close to 100% of our students use ISAs. And that's, we think one of the powerful elements of income share agreements and the way they work is they align the incentives of the school with the incentive of the student. So, we're not going to make money unless our students are getting placed and hired and paying back. And that's a really powerful forcing function. So everybody at Lambda School knows that their salary is dependent upon making sure that every student is successful in their journey. And that plays in a few obvious ways, and then in a million subtle ways that it would be really difficult to replicate with goodwill or, just hoping that the students are doing really well or knowing that you'll have to produce some outcomes report. I think, incentives really, really matter. And we've built Lambda School in such a way that, we have thousands of students a year, and the vast majority of them are using ISAs. So our average student coming in is kind of 31 years old, and there's a kind of a bell curve around that. There's a little bump around, 18 years old of new, people opting out of college and into Lambda School. About half of our students have degrees, half do not. The vast majority are outside of tech. The vast majority are outside of San Francisco and New York. So our average income coming into Lambda School is right around $25,000. And our average salary for a place grad on the other side is north of $75,000. So we really focus on, going all in. Lambda School's 9 months long, full-time, 18 months part-time. So a very intensive environment entirely based on ISAs.
And Austin, are Lambda ISAs funded by the school off its own balance sheet, or do you have a captive funder who does that in partnership, or how is that handled?
Yeah, we fund them in a variety of ways. We do work with Chuck and Edley to fund many of the ISAs. Some are on balance sheet, and the beautiful thing about markets is the more risk that we take on, the more valuable the ISA will become in the long run. And so there's constantly that trade-off of the longer we can hold it until a student is placed, the more valuable that ISA becomes, and then there are cash flow issues on the other side, and that's kind of the name of the game, is figuring out how to make that all work. So we are VC backed. We've raised just north of $120 million of venture capital, and then we work with Chuck and other financing partners to help fund the ISAs.
And so Austin and Dan, do you find, is there a relatively low amount of variability in terms of the kind of the exit salary and income progression of your graduates, and which then creates the opportunity to pretty tightly price an ISA because you have a pretty good sense of what the outcome is going to be, assuming someone completes the program, or do you have to price with a level of variability that encompasses sort of completion and placement risk?
I would say we see I would call it a moderate level of variability. We're not throwing away outliers. We're not talking about 2 to 3x. I would call it outcomes by topic, plus or minus 30% would capture the overwhelming majority. Now, digital marketing is different than software engineering, is different than data science. Right. So topic to topic is quite variable, both in who it attracts and what the entry and mid-level jobs pay.
And are the ISAs offered on different terms to different program enrollees?
They are, exactly. It all ties to what would the upfront tuition be, which is generally correlated with length and expected salary on the other side. So our shorter programs tying into lower paying entry-level jobs or intermediate jobs generally are more affordable. And the most affordable ISA we have would probably only take about a year and a half term, with a cap that I believe is like just under $10,000, right around $10,000.
Okay.
For us, sorry, go ahead. For us, it's slightly different. We're very distributed geographically, and the geographics actually contribute a lot. So whether someone's getting hired in San Francisco or rural Ohio, they may be at the same level of aptitude, but the salaries and the incomes will shift. So we priced everything the same on our end, and we have to deal with the variance internally. Most of our students, we do have a capped ISA. So once you have paid back X dollars, and a lot of students will hit the cap.
Let's see. Great. Go ahead, Tess.
Yeah, just to add in there, I think it's interesting. So we have a dual-pronged approach where we'll partner with providers. When you think of a thing for Lambda that has specific prices per student, but we also have our direct-to-student offering, which obviously you have students coming across various different programs and, tons of schools across the U.S. that, clearly you have to price very differently. And I think in order to drive the most fair rates for students, data science is an incredibly important part of building a very robust ISA offering. And so, first of all, early on into our history, we had done an asset acquisition of another player in the space, Base Capital, which was basically a team of engineers that spent 4 years building proprietary ISA models, basically saying, can we solve for the shape of income over time, which is far harder to know than what income looks like at any point in time. And beyond that, I think the other piece is pricing in a cohort basis like Lambda or Thinkful has is really critical when you think about this from a regulatory lens. It's completely fine to underwrite individuals specifically, but when you price, you have to make sure to do it in a cohort basis so that there's no unfair advantages given to one individual versus another in the same program in school. And so that is definitely one of the ways that I think many of our players in the space have been very proactive to make sure to do that fairly, transparently, and make sure students really understand the costs and have the right tools when they're making that decision to take an ISA versus a private loan.
Great point, thank you. Chuck and others, please feel to jump in as well. How are the major capital markets players, investment banks, hedge funds, insurers, others, looking at the sort of nascent but growing ISA marketplace, and what will it take for those larger players to eventually become significant funds providers if they aren't already? Chuck, you're on mute, I think.
All right. The last 4 years has been a big education process for the institutional community. I would say that at this point, they completely understand ISAs as an asset class. They appreciate the investment points about them, which are, number one, this is a major social impact investment. There are only so many wind farms these ESG funds can invest in. And every dollar of ISA is another student loans off the street, and that's considered a social good. And so a lot of the participants in our market are ESG and social impact investors. Number two is these are attractive yields in a zero interest rate environment where BBB bonds are yielding 2.5%. The double-digit returns available in our marketplace are very attractive. Number three is, because they're tied to wages, this is viewed by investors as a major play on inflation. A lot of people pay up for inflation protection in their portfolio to protect against inflation eating away at their holdings. But by receiving a fixed percentage of wages, you can actually participate in inflation. And I think there's more demand overall in the market to invest in ISAs than there actually are ISAs in the US. And part of that, I would say, is thankful to the good performance. So I would say that Austin, for example, has done an incredible job managing through the COVID economy. We priced a sizable pool of ISAs for Lambda School in January, and we were not anticipating a global pandemic and record unemployment. And that pool is actually outperforming initial expectations. And that's a kudos to the education community for being able to do that. Also, I would point out that Lambda School, they're not selling their ISA contracts off to the street. They're selling pro rata participation rights, and they're maintaining a lot of the risk, which is a major signal both to students and the marketplace. And literally the largest institutions in the world would take chunks of $50, $100 million ISAs. Were we able to originate them, which I think we will be.
Yeah, I would add to that, Chuck. I'd say, I definitely do see an increasing number of inbounds from investors that are really interested in the space, looking to learn more. And as you look at players who have great outcomes like Lambda or like Thinkful, you'll see more come to the space. I think the three biggest drivers for how we'll see growth from investors is really around scale. As ISAs become more mainstream and more easily adopted, you'll definitely see investors that have minimum size allocations, like $100 million, like your large bank, being able to actually invest in the asset. The second is really just around data. As more and more data comes around repayments and performance, you'll see investors get comfortable around the risk, especially given these are non-regulated and not rated yet. The third is around regulation. Obviously, we saw 2 bills proposed in Senate that have gotten bipartisan support, and that would be a huge tailwind that would really help increase capital in the space. And the last thing I'd mention is really the benefit of ISAs to really shift income curves and drive increased performance. With a loan, all of your best performers are capped at that interest rate. With an ISA, you have the benefit of being able to truly align the incentives of that cost and value of education and also drive students toward better outcomes, like Lambda and Thankful do through their career support offerings. And similarly at Stride, we bake a lot of that into our offering itself. And so I think that itself will give investors a lot of comfort around the expected return.
I'm going to take a couple of questions that have come in from the audience. Chuck, I think this one's probably for you related to your ED score. How are placement and salary data for the ED score obtained and calculated?
Either through public information or directly from the school themselves. So one of the great gifts that the Obama administration bestowed on the American public is the college scorecard. The Department of Ed college scorecard site tabulates average debt per major by school, average salary per major by school. So if you're wondering, okay, I'm gonna major in English at University of Wisconsin, what that might hold for me when I graduate. That data is paramount. We also buy private data. There are many private data sources like LinkedIn, PayScale, and others. And so we're really trying to triangulate on a most likely outcome per student. And the more information, the better. But it's a combination of both publicly available information and private mined data, sometimes from the schools themselves.
Right. So, Austin and Dan, obviously, an ISA program, at least initially, is a proprietary product or a competitive advantage for one institution versus another. What is the level of collaboration and information and data sharing that is happening in the career training space that's helping expand and deliver this funding option to other schools? Is that actively underway, or are there competitive barriers to that being able to happen?
I see a ton of collaboration, and frankly, I don't see it as a competitive advantage. I see it as just part of doing business more and more, and especially as folks like Tess and Chuck make it possible for even small schools to do it. We have the privilege of being part of a public company that has a war chest on its balance sheet, and that lets us be more aggressive than when we were a C-funded company in 2013. But I don't see it as a competitive advantage. I'm very, very open about how we thought about pricing decisions and when we introduced it and what's worked and what hasn't worked. Back when we were a private company, we had a board member who was on the board of other schools offering ISAs, and we talked regularly and shared information. So I think we're private about very little, with the exception of anything that we legally can't share because of being a public company. Right. But we're always very open to sharing our lessons learned with it.
So is it fair to say that when students are looking at IT career training options, terms of specific ISAs is not really a point of comparison or differentiation?
It would be a minimal one. I mean, at core, there's, call it 40 or 50,000 people enrolling in boot camps this year. Mm-hmm. If you take the top 10 universities, there's probably not enrolling this year, but total enrolled about 1 million. Yeah. So fundamentally, we are 5 times cheaper, 4 times faster in all of those options. And together, we're trying to put pressure on the entire market to say, you need to teach more relevant skills for lower costs, where your incentives are more in line. I want everyone to succeed, and we're not going to do every single topic in the next 6 months. So we're happy to see others learn from what we've learned over the last 3 or 4 years.
Great. Austin, anything you'd like to add?
Yeah, I just agree with the general sentiment that, what competitive dynamics there may be, like everybody on this call is trying to fight the same fight. And that is to help education be cheaper, faster, more affordable, more aligned. And I think Tess and Chuck have done a great job of helping those who are not using ISAs understand, how it works and the benefits. And I don't think having an ISA or the terms of an ISA, I mean, you may be able to offer better terms if you have had stronger outcomes for longer. And I think net that's a good thing, right? Over time, you want schools to be able to price themselves differently because they are so successful. That's a great thing.
Right.
I think we have yet to see that really shake out in the ISA space. It's way too young for that. But over time, the hope is that all of the best schools will be the biggest, and that all of those that are in which students are not successful either shrink or go away. And I think that's really, really healthy.
Right. That is a really critical point to emphasize is at least prospectively or aspirationally the market signaling capability of ISAs, and that less expensive ISAs ought to correlate to better quality programs with better outcomes for students. At least that would certainly seem to be the logic. I'm going to take another question from the audience. Starts with a statement. I don't think the traditional schools are very focused on career outcomes. They care more about admissions and graduation rates. Do you think ISAs have the potential to make more schools focus on collecting and reporting short and long-term student outcomes? Just kind of put that out for the group.
So I think inherently a lot of the alternative education players like Lambda, like Thinkful, were built to help students with the ROI of their programs. And you only would see enrollment growth if you are delivering on your promise that students will find good jobs and you've built the right support systems. And I think when, often in your press release, when you raised a lot of VC funding, it seems like a lot of that will be allocated toward those initiatives. In Title IV, I think one of the benefits that we'll get through ISAs as we collect more data is really seeing which schools are actually delivering on their promise of ensuring that their students are placed in really high quality jobs, are getting really high quality education. And I think, oftentimes you hope schools will pick up on this, but many times us providers can be partners to the schools. And so, for example, with Stride, we built a lot of career support tools that are tailored to the types of students that we focus on, which is primarily STEM and healthcare students. And I think that's really important, especially within Title IV. And I think as the market expands, you'll definitely see more pressure where students are deciding what is the value of that education. And COVID has only amplified that, as you see a lot of students taking gap years or deciding to go to a boot camp instead of go back for an extra year of online courses, via Zoom, right? And so this is definitely a moment in history where I think schools will finally have to be more proactive in that regard, for sure.
Somewhat mechanical question. Are ISAs reported to credit reporting agencies? And if so, can that be problematic to students building credit? Has it been determined yet what the consequences are for non-payment?
That's underway right now, where the servicers are just now building the links with the reporting agencies to be able to do this. And in one sense, an ISA can be very enhancing to a young person's credit report because you're making payments, you're getting credit for payments, but there's no associated debt.
Yeah.
But that is not really a part of the market yet. That's just underway with a handful of servicers. Literally started in the last month or two. Mm-hmm. And it's important to recognize that a default in a student loan is very different than a default in an ISA. Students default on student loans typically because they're not working, or they're working but they're not making much money, so they can't afford the payment. With an ISA, if you're not working or you're not making much money, you're not supposed to make payments. You go into deferment. So the concept of default in ISAs is very different. A default is where you're working, we know you're working, we know you're making above the minimum threshold, you just don't want to pay. And then it does become a debt, and it does become reportable to the agencies.
Thank you.
Yeah.
Dan and Austin, wondering like how closely your institutions work with employers that are obviously interested in hiring your students, and whether or not there is any appetite yet among employers to share the payment burden on student ISAs, and whether you think that it's likely that ISAs could evolve into a hybrid model where both students and their employers share the repayment burden.
Yeah, I can speak to that. I mean, the first answer of how closely do we work with employers? I mean, really closely. That's how we get paid, right? We get paid by students getting hired, so that's more important to us than anything else in the funnel. It's more important to us than admissions. So we have teams that work on that, and we have we work incredibly closely with the hiring companies. We're just barely beginning to see the uptake of employer shared payment plans. So we've had a number of employers decide to pay off ISAs for students, either a pro rata amount each month, and some have actually just paid off the ISA basically as a hiring bonus. That's something we're working to enable more of. We love that, the employer loves that, the student loves that. It's still really small as a fraction of our student body, but in an ideal world, if that were 100%, I think everybody would be happier.
Yeah.
So there's a lot of logistics and income reporting, and how does that work with tax treatment and that kind of thing that remains to be fully solved. But I think that's something we'll see more of over time.
Great. Anything to add?
No, I agree with all that.
Okay. So we're sort of approaching we're about 5 minutes out, so I'm going to kind of put this out there for everyone. Maybe everybody can take a shot at it for a minute or so, but just interested in people's thoughts about the potential impact the upcoming federal election might have on the ISA marketplace in terms of its growth and development, particularly with regard to the regulatory framework as currently exists and as might be impacted by the outcome of that election. Tess, do you want to go first?
Yeah, absolutely. Happy to. So I think from all of our perspectives, I think regulation would be a strong tailwind in the space. And, we've seen the bills on the floor, and we would love, to just have advocates support putting some validation around what are best practices for the space, right? The one big risk we have is a bad actor who doesn't put caps, does use, have usury terms with students, and makes the product not sustainable, right? So I think as we think about the upcoming election, we've seen bipartisan support in the recent bills. Initially, they were proposed by Marco Rubio and the Republican committee, but I think the Democrats really appreciate the idea of student centricity or student protections, and Republicans appreciate the free market system. And so in both regards, though, I think we all need to be very disciplined with how we think about our own regulation and aligning as closely as we can with the private lending industry, and really thinking through what are the ways they've thought through, partnerships, the right licenses, et cetera, and really being proactive in that sense. And I think, I can speak for the folks on this call, we all have been very thoughtful on being collaborative with each other and creating, ISA alliances around how do we speak similar languages to make sure that we are being transparent with students and doing it the right way. So.
Anyone have anything to add to that?
From a school perspective, we've certainly prepared for and expected some form of, let's call it sensible legislation from day one here. So we've just been careful to make sure under no circumstance would a student pay more than, say, 1.5 to 1 3/4 what they would pay in cash if they were paying up front. And under no circumstance does the student pay more than 15% of income. Under no circumstance does the burden last an incredibly long time. The absolute longest it could last is something like 4 years of payment, or if you include a deferment period, call it 6 years, which pales in comparison to the decades that people are paying off student debt. So we read every draft that comes out in case anything does get passed. Obviously, depending on what happens, it's more or less likely to happen. But we've certainly been cognizant, and from what we've seen with, let's say, 96% of other schools in our market, what we're doing is so much more affordable than traditional education that nobody's even getting close to the kinds of limits that legislators are thinking about. The only folks who could get close is folks who are trying to cover much or most of a 4-year education that's really expensive, that's going to take a large percentage for a lot of years to pay off. But the folks in the market are generally way clear of any of the sensible legislation that I've seen.
I agree. I would only add that it would be nice to be regulated. I've never seen an industry begging to be regulated as much as this one.
Right.
That is a positive. But at the same time, everybody in DC has told us not to hold our breath. Congress can't even agree on the Pledge of Allegiance right now. And so let's hope that the next 4 years have a different tone.
Agreed. Okay, we are at the end or near the end of our session, so I want to, first of all, thank our panelists for sharing their time and insights and expertise with us. Also apologize to the audience. There were a couple of questions that were asked that we didn't have time to share with the panel, but I would encourage folks, if they would like to email me directly, I would be happy to communicate with folks on the panel and get you an answer and get that back to you. But I appreciate everyone's time. Thank you for your attention, and everybody have a good evening.
Thank you.
Bye.
Thank you.